Welcome to the deep dive video update. This is a video that I do each week where I pull out some of the charts that maybe I didn't use all that much throughout the week. And there are other charts that are unique just to this particular video. Now, the reason this is called the deep dive video is we have to look deeper. We have to read more into what we're seeing in the chart and try to interpret that to see if we're getting any clues as to what's happening in the overall market. This is being prepared for Monday, August 4th. Before diving into today's video, if you find it helpful, consider a 30-day free trial to the SPX investing program. This trial lets you explore my unique approach to market analysis. Full-length daily and weekly videos are available on a delayed basis after the market closes. For immediate access, become a member by clicking on the link below. This first chart is mainly for informational purposes. It's a long-term range of the VIX. Now, we went back above 20 on the daily chart in Friday's session, and that's negative. That means fear is really increasing. But when we look at the 50-period exponential moving average of the VIX, it's still going down. So in the bigger picture, we're still positive, even though shorter term, we're looking a little bit more fearful and negative. And we look at the VIX and then a correlation of the VIX with the S&P 500. Still getting quite a low reading here, so I haven't been using this chart. We really only pay attention to this if it goes above the dashed line. We're not there yet. Then we look at the VIX, and then there's this thing called the VVIX, or volatility of the VIX, which measures how volatile is the VIX itself. And we do a ratio with that. And in the context that we've been looking at lately, as we've been coming up out of the April lows, this ratio has been going down. And so as long as this continues to decline, that's going to remain more positive. We look at the Ulcer Index, another sentiment gauge. It's picking up a little bit here. Friday was pretty negative and kind of caught a lot of investors off guard. And so we're seeing some fear coming back into the market. What we're going to be watching for is whether that's going to continue. Was it just more of an overreaction on Friday and then people go home over the weekend? It's like, well, maybe I should buy instead of sell. We don't know how that's going to play out yet. What we're going to be watching for is as we enter into August, which is typically more of a negative time seasonally, and then September as well, is this turning into a more substantial decline? If that happens, then this Ulcer Index will go above the moving average. Then I'll start using it in the daily videos. We look at the volatility of stocks, the VIX, volatility of bonds, the MOVE Index, and we can see this really spiked up in Friday's session. Bonds were up and interest rates were down. And that's what we often see during uncertain times. It's called a flight to safety, getting out of risk assets like stocks and getting into more risk-off assets like bonds. And bonds can be risky too, but in a general sense, bonds are considered to be less risky. And we did see a real spike up here. We have been going down with the 50-period moving average of this ratio. It's ticking up just a little bit here. If this still continues, that's going to be more negative. As long as it's declining in this context, then it has been more positive. We look at a ratio between the large caps and the small caps, and the small caps got hammered. And so when this ratio goes up, that means large caps, even though they got hit, small caps got hit even more. So that's why this ratio is going up. This is for informational purposes, just measuring from major lows that we set back in 2022, 2023, and then April of 2025, and what the percentage gains are as of Friday's close. Then I was really focusing on this, but we never got up to this dashed line here. When we get too far away from the 200-day simple moving average, that happened back in 2023, it happened back in 2024 a couple of times. And then when we get too far away from that, that's when we tend to see a pullback. Well, we don't know if this is going to develop into more of a pullback, but we never got up to this 10% level here. Anchored moving averages going to major highs, major lows. Price, even when it declined on Friday, we're still above all of these lines here. Now, this could end up being pretty good support. If we do continue to decline, These lines are still going up, and there's a whole lot of them kind of bunching up right here. And so the market may be more inclined to bounce up off of one of these, but they're still far away. We would have to drop well into the 5,800 level just to get down to the highest of the anchored moving averages. Then I haven't been showing it all that much, or the advanced decline line studies, the little deeper studies. So I'm showing them here. We have some more general studies. I look at the S&P, we look at the market as a whole, and we're not really seeing that big of changes right now. We did pull back with the cumulative advanced decline line for the S&P based on price after setting an all-time high, and also pulling back after setting a high when we base this on volume. And we look at the NYSE. This is cumulative, the advanced decline line. We did see quite a decline on Friday. We actually dropped below the 50-period moving average. Are we going to stay below that? That's what we're watching for now. And we declined with the regular NYSE advanced decline line, but we're still above the 50-day moving average. Also still in an uptrend with this other NYSE advanced decline line above the 50-day moving average. And then we break it out just based on common stock. Saw a pullback based on price and volume after setting recent all-time highs. Then we have an advanced decline ratio. This is shorter term based on 19 periods. I show a version of this in the daily video each day. That's a blue line for the advanced decline ratio. This also shows that same thing, and we're below zero based on price, so that's turning negative. But this chart also shows it based on volume, and we're dropping below zero there. So in the short term, that's why we're switching over and taking more of a negative stance right now. Plus, we closed below the 20-day moving average. Then momentum stocks, which tend to hold up a little bit better. Now, as we got deeper into July, we had a really solid open on Thursday, but then we went down from there. And then Friday, we gapped lower. So we lost a lot in a couple of days. And momentum stocks tend to hold up a little bit better, where they had been drifting off as the market's been going up. These are stocks that, again, just do a little bit better when the market's under pressure. When we look at US versus international stocks, we were trying to build some kind of a base here, and we were seeing US stocks starting to come back. That pulled back over Thursday and Friday. We'll see if this continues to go down or if we start to go back up, but not really getting any major insight. We're not seeing a really big move like we were seeing back in February, March, and into April. Then technical alerts, these go from Monday to Friday. When they're red, they're negative. When they're green, they're positive. We had some negative things happening earlier in the week, but then things really turned negative on Friday. Everything is red except for gold, which is another safe haven. And when there's uncertainty, people tend to flock to gold. So that ended up closing higher. But a lot of damage was done. We crossed below a lot of pretty significant levels, both with the S&P, the NASDAQ 100, and the Dow. Then we rank 6 different indexes on a scale of 0 to 100. The higher the score, the better looking the chart. And we saw earlier in the week, these scores were looking better, but then after Thursday and Friday, these scores really deteriorated here. So coming in first place is the NASDAQ itself, not the NASDAQ 100. This is the broader NASDAQ at 79.1. We like this to be up into the 80s, even into the 90s, and it was looking better, but then it took that pretty big hit on Friday. In second place is the NASDAQ 100, is represented by the QQQs, coming down and coming in second place at 78.2. And then we have the S&P in third place. It's very common. For a lot of the last few years, we usually see the Qs in first place, the NASDAQ possibly in second place, and then the S&P in third place, because the S&P is a mixture between growth and value. So it took a hit in Friday's session, coming in at 59.7. Then we have the Dow, which didn't quite get back to set a new all-time high. It was generating a recent golden cross, had an uptrend, but it's been really trailing off lately, coming in distant with this score from the previous score at 20.5. Mid caps also seeing some weakness. They generated a golden cross this week, but price hasn't really been cooperating with that. They're coming in at 14.2 and back down, not quite to single digits yet, are the small caps, They were improving, getting up into the 40-50 range here, and now dropping back down to 10.2. Mastering the stock market is challenging and can take decades to achieve. Most beginner traders and investors feel overwhelmed and often fail. Stay ahead with the SPX investing program. Members gain access to the full program. Other options include immediate access to videos as they become available. Alternatively, the daily and weekly newsletters may be helpful. Click on the link below to find out what's best for you. Short-term rainbow. Now, we haven't been inside the rainbow very long yet, so the lines really haven't started to roll over. That's what we're going to be watching for. We have turned negative in the short term because we're below the 20-period moving averages, both the simple and exponential. The longer we stay in here, the more these lines are probably going to start to roll over and go down, but they haven't really started to move much yet. And we are looking at the 20-period simple and exponential moving average. I wasn't showing this in the daily video. I did show it for Monday's video, but the positive thing that was really happening is once we finally broke up out of this craziness back in April, we got above the 20-day moving average, and we were able to stay above that. Even with pullbacks, we were above the 20-day moving average. So for the first time now, since this big downward move, we're back below the 20-day moving average. And the longer we stay below that, the more these lines will roll over. And until we actually close back above the 20-day moving averages, we remain negative in the short term. Intermediate term rainbow coming down, but still haven't even come to the rainbow yet. So this is still positive for intermediate term investors. Then a 50-period moving average, we're going to be watching this because now that we're below the 20, we start watching the 50-period moving averages to see if we come down here and this provides some kind of support. And if we break the 50-day moving average, then we'll start to watch the 100-period moving averages. Then these are just percentages, how much we've gone up through periods of time, and then how much on a percentage basis we saw the declines here. And we're off the highs. I mean, we set an intraday all-time high on Thursday, and then boom, we had the rest of Thursday and then all of Friday really give back a lot of gains. And it's got a lot of people nervous right now. The S&P 100 performing better than the S&P 500. The 100, those are the biggest stocks that make up the S&P 500. Now, they both got hit, but if you look at the intermarket analysis video, we still see the S&P 100 on a ratio basis outperforming. And that's what we see when the market is still positive. Now, if that starts to shift, then we'll turn a little bit more negative as well. Mass index, we're not getting a signal here on the daily chart. We are working off of a weekly chart mass index, which is a reversal signal. That was triggered as we were going up on the weekly chart. And now that we're going down, we're wondering, okay, was this valid after all? And then standard deviation, as long as we're below the moving average, I don't use this in the daily video. This just measures how fast are we moving, either up or down. But even with the decline that we just saw, this goes over the last 10 periods. So there was some upward move and downward move. So overall, we're not seeing an awful lot of movement yet. This was being used throughout the week. We were getting extreme positive with the CMB composite since we got above this black line. Now we've really turned negative, dropped below the moving averages and getting quite a low reading now. And we were just a little bit above the upper Bollinger Band. In fact, we opened above that on Thursday, but then closed down below it. So we're seeing this show some more weakness, and now we're dropping below the midpoint and getting lower to the lower Bollinger Band here. Now, one thing that I've been trying to point out along the way, and this is a little bit subjective here, is when we see the bands are really far apart from each other, that means we're really trending, we're really moving. Well, these bands started to get closer to each other, and I liken it to when you wind up a spring. The tighter you wind it, the more the movement is going to be. We're just not quite sure if it's to the upside or downside. As of halfway through last week, you could have easily made a case that we were going to break out to the upside. Things were looking positive. GDP came in stronger than expected. Even Thursday with the weekly jobless claims, those are still looking pretty solid. But then you have all these tariff news coming out. You got tariffs hitting other countries. You got trade deals and all these things that are happening. Plus, the market was quite overbought. And so we really haven't broken out yet. If we continue to fall down here and the Bollinger Band, the lower one, starts to roll over, then that would look more like a breakout to the downside. Then the praying bottom fisher, we're actually getting kind of close. We were getting one back in July, even though we didn't decline very much here. And if we cross back above with the black line above the red line, that would be another buy signal. Then a long-term rainbow. Again, we've been falling, but we're not even down to the rainbow itself yet. So this is still positive. And here's the daily special K chart. We continue to be positive on the weekly chart. We continue to be negative. We were getting close, and we were just about ready to cross above this red line. And that's when things started to turn and come down. Then we look at a weekly chart of the S&P, a weekly chart of the DAX. We can see that the correlation is getting a little bit stronger again. So U.S. stocks and German stocks in the EU, they're moving more in tandem with each other. Then Ichimoku cloud, we did decline. We're seeing where the green line is starting to come down. That's more short-term negative. We dropped below the blue line and the red line. That's negative. We're starting to see the blue line rolling over, but it hasn't quite crossed below the red line. If this does cross below, then that would mean that the intermediate term trend is turning more negative. But even with the decline, we're still well above this green cloud itself. And if we do continue to fall, sometimes this cloud will end up providing some kind of support. Then we look at the VIXen, which is the NASDAQ 100's version of the VIX. It also spiked up where it had been declining, both with the bar chart and the line chart. Then we look at the S&P on top and a growth to value ratio here in the middle. Not really much of a change, but we're pretty much neutral with the correlation between the top chart and the middle chart. And the transports, that's the red line, they were really improving, but not on Thursday and Friday. And even the Dow didn't quite get back to a high here, but it's starting to decline as well. And then we look at the regional banks compared to the financial sector. We're seeing that the smaller banks are back to going down with this ratio. That means that the smaller banks are underperforming the financial sector. And the bank ETF took a hit. It's been in an uptrend. It's still in an uptrend, but now it's coming down. It actually fell below its 200-day moving average, but was able to close back above that. However, it's still below its 50-day moving average. And then we're not really getting a lot of insight here. This is energy to the 10-year bond ratio. Going back to 2023, we've just been going sideways more or less here. And the gold to S&P ratio did turn up a little bit. Gold hasn't really been moving, but the S&P went down while gold has been going sideways, and that's why we see the tick up here. But we're still seeing this ratio going down overall, meaning stocks have been outperforming gold. Then emerging markets compared to developed markets like Europe and the US, still seeing a bit of a general improvement here. And then we look at the 10-year yield for the US, the 10-year yield for Germany. We plot the US dollar index here, but we still see that there's not a strong correlation between the two. We've been coming down here with the yields, and the dollar index has been seeing some strength, and that's why the correlation is not very strong right now. The German DAX, it's fell under its 50-day moving average, and now it got hit pretty hard on Friday as well. And then we look at a ratio between U.S. stocks, the S&P, and German stocks. And we're seeing a general improvement here with U.S. stocks outperforming. If this ratio goes up, that means that U.S. stocks would be outperforming. And then the QQQs, the ETF for the NASDAQ 100, looking really solid here above all the moving averages. Well, we dropped below the short-term moving average. This is a 20-period moving average here. That's why we're turning more negative in the short term. But the lines are still going up for right now. Keeping an eye on retail, well, we've been kind of going sideways here when we look at the retail to S&P ratio. But overall, it's continuing to underperform. And we did see some weakness in retail coming back down below its 50-day moving average, but it's still above its 200-day moving average, and the RSI has now dropped back below 50, so some weakness there. Then we look at some different ratios. Discretionary to staples, the weighted version, it got hit pretty hard because Tesla and Amazon, they're the biggest parts of discretionary, so the weighted in sectors, they have more of an impact, so we saw a pullback there, Or if we look at the equal weight version of discretionary to staples, that went down, but it's holding up a little bit better. And now we're seeing tech to utilities, growth to value, that's declining. We actually saw a bit of a move up here when we look at biotech versus healthcare. Healthcare has just been getting hammered like crazy. But then we are seeing some weakness when we look at hotels to utilities, another growth to value ratio that's continuing to go down. Then what they're called bellwether industries here, seeing a pullback here with the semiconductors, actually a little bit of a bounce up because interest rates were going down. And so the home builders went up a little bit on Friday. We are declining with the transports after we had been improving, also declining with retail and declining with the regional banks. Then some long-term rate of change charts. I just use these for information. We are pulling back, but we're still well above zero. This is also 250 periods. We're also pulling back, but still looking positive longer term. Then we look at the relationship between different kinds of bonds to see, okay, is the market getting concerned about interest rates going up or inflation going up? Well, not here. When you look at cash to 3 to 7 year bonds, when this ratio is going down, that means the market's not concerned. When we get concerned is when this ratio is going up and actually trending higher. And we look at TIPS, which are Treasury inflation protected securities compared to 3 to 7 year bonds. When the market's concerned about inflation and interest rates, TIPS outperform. They're not outperforming now. Bonds had a pretty good day on Friday. Then we look at TIPS to 7 to 10 year bonds, also a really big decline here. So according to the market, they're not worried about inflation and interest rates, at least right now. Then we look at the S&P 500, which has been declining, and the long-term bond, which has been going up. We can see the longer-term correlation is pretty much flat, but they're having a tendency to go in opposite directions in the shorter term. Then we'll do that same thing with the Qs, which have been under pressure as the long-term bond has been going up. So still having a slight tendency to go in the same basic direction with the long-term correlation. And we're still seeing a general drop off here with the 2 year Treasury yield, which has been helping stocks. When this goes down, that tends to help the S&P to go up. Stocks like lower interest rates. And we're back to being inverted again here with the 10 year to the 3 month yield curve. Most people follow the 10 year to the 2 year. I also follow the 10 year to the 3 month, and we're back to negative again. And once this stops being negative, but we've been chopping all around here for quite a while. But when this really gets moving and starts to go back up, then that might be signaling that there could be a recession off into the future. The Eurozone with European stocks compared to American bonds here, then the Eurozone really underperformed on Friday, but had been pretty much above the rainbow, but seeing some recent weakness in this ratio. With each video and course, members learn to implement the consensus approach, a unique analytical method. Unlike relying on a few indicators that eventually fail, this approach overcomes analysis paralysis by using the weight of the evidence to draw conclusions. Developed over decades across all market conditions, explore the SPX investing program and start with a 30-day free trial. And so we are declining with those stocks in the S&P above their 200-day moving average, but we're still above 50. So that's holding up for now. And we're just a little bit below 50 with those stocks above their 50-day moving average. And seeing more weakness here with the mid caps dropping further below 50 and the small caps even further than that below 50. So some weakness is starting to come in that way. Then we're still holding up for now with the SPY to staples ratio. When this is going up, that means the SPY is outperforming staples, which are more defensive, similar to what we saw back in late 2021. That caused some concern. Right now, there's no concern. Now, if this continues to go down like we were seeing when we were really falling back in March and into April, yeah, we're going to get more concerned. But right now, we just are seeing a pullback to the highest moving average here. So thank you. I hope you found this helpful. I hope you're having a wonderful weekend, and I will talk to you in the next video.